live stream right now. And I'm muting myself. And yeah, we're live.
Okay.
So we are live. Awesome. Hello, everyone. I'm Alex, the founder of GTON Capital, admin of Lobster Chat. And today we have an interesting topic. We'll talk about lending protocols. Of course, there will be some basic introduction what is lending. And then we'll go and explain more about details, ask and write some questions. And today we have our friend, one of the biggest project in the lending protocol space, which is Euler, and Seraphim from Euler is here. So Seraphim, just a couple of words about yourself, and we will go to the presentation and end up with questions, answers, and just topics around the lending protocols.
Hey guys, it's great to be here. Yeah, I'm Seraphim. I'm head of risk at Euler, but I do a bunch of things really. So I guess I should probably talk about my background a little bit. I used to trade I come from TradFi, so I used to trade emerging market currencies, on the trading floor, stuff like Russia, Turkey, South Africa. And then I basically just pivoted into DeFi because I was following crypto for quite a few years, but DeFi specifically got me really interested beginning of last year. And I pinged Paradigm. They put me in touch with Euler, which at that time was just they just raised Series A basically, so it's pretty small, like 5 people. Now we are 26, I think, so we've grown quite a lot. We deployed last December 2021. Lots of users. It seems pretty. Yeah, it's like I've seen the whole thing basically, which is quite cool. So, yeah.
So what are you doing right now? Like, what is your plan, expansion plan? How do you compete with the AVA? Sorry.
Yeah, this is exactly what we're thinking about. So there's 2 things that we're probably going to do in the next few months. One of them is working on an isolated environment where you can do a lot more things than on main Euler. We call it baby Euler so far. So you could create sub isolated pools where you can do a bunch of crazy things while not fragmenting liquidity. Our interest-bearing tokens are called e-tokens. We're thinking it might be a cool idea to create an isolated environment where you use e-tokens as collateral. So people still have to kind of use the main Euler in between. It might be not too far away from Silo, really, just with a couple of changes. So that's what we're excited about, because you could do anything there. You could have like very high collateral factors. You could have different assets as collateral that you can't use now, like Squeeze or like like Coinbase ETH or stuff like that. Yeah. And the second thing that's in the works is kind of we're trying to address the Oracle issue, like after the merge. And one of them is Chainlink, but down the line, I think what we'll do is create our own Oracle solution, like a decentralized Oracle solution, basically a DEX, really. Yeah. Interesting.
I already have a bunch of questions for you to the end of this stream, actually, especially with Oracle. Awesome. So guys, let's start from the overview of lending protocols, and then we'll see the stat around that and how it works. Arya, please, next slide.
Okay, hello everyone. My name is Arya. I'm the head of community at GTON Capital, a DAO that's builds infrastructure for new digital capital markets, namely L2 rollup. GTON network with a stablecoin as its native currency called GTD. And we have a bunch of DeFi products too. Alex is GTON's founder. He can explain more. And I have a question for you, Alex. Seraphim told us about Euler. Could you tell us more about GTON? Because we might have some friends from Euler Finance who might not know GTON as well as Euler. Please go on.
The idea is pretty simple. Thank you for introduction, Arya. The GTON is basically optimistic rollup on top of Ethereum. But the key factor here is that the native token for the Ethereum rollup is basically decentralized stable currency, which is GTD. The approach is simple, same as DAI or another crypto collateralized stablecoin works. But the idea is to use the algorithmic stablecoin, actually not algorithmic. Sorry for that, for this term. It has some different meanings right now, but collateralized or decentralized stablecoin as a gas currency for a lot. So we are thinking that this will push adoption even further. So yeah, this is basically what we are doing. And let's start from the topic.
Okay.
The stream.
Thank you, you two guys, and nice to meet you both. Let's get straight to the topic, Alex. Are you guys okay with that?
Yes, yes.
Okay, let's start with that. Money markets are the platform where borrowers and lenders can meet. Throughout history, money markets have been generators of economic activities. With time, money markets altered, and blockchain gave us DeFi and decentralized money markets. They are self-propelled structures run by a smart contract. We're explaining for our viewers. I'm very excited about this. Sorry about that. There are obvious advantages of centralized money markets, such as immutable. Once it is running, a smart contract cannot be interfered with, thus making it free of human prejudice. Decentralized, managed by a global community of stakeholders through a highly decentralized network of nodes. The third one is it's permissionless. Anyone online can earn interest, their capital, and or borrow funds of their needs seamlessly. And the fourth one is non-custodial. This fifth one is composable. DeFi is a money Lego, over collateralized, and it's the last part, over collateralized. So let's start from a general question, guys. I have a question for both of you. Can you name a key advantage that is a killer feature or X factor for the decentralized money markets, and one greatest issue? Alex, can you start, please?
Yeah, but before going in answering question, I suggest to go through the slides and talk about that.
Oh, sure.
The context. Is it okay?
Yeah.
Awesome. So yeah,
cool.
The money markets. How it started? Basically, we have two players. We have borrowers who need some funds for whatever activity, probably trade with the long, right? So using extra leverage to trade. And we have lenders who basically have some money and are able to lend it. So and basically the lender is providing liquidity, and the borrower is using this liquidity for any purposes and pay interest for that. And of course, they have some kind of fees from the system. So this is how general money markets works and the lending protocol works. Please, next slide.
Sure.
Aria. Next. So yeah, here you can see the good example how so-called CFI or CDFI works. What means CFI and CDFI? CFI means centralized finance. So basically, it is any service where you can borrow some money with the using collateral. Or CDFI, they are pretending to be decentralized or positioning themselves as it is, but so basically they're using centralized approach for that. I mean, the backend server, almost not using smart contracts. It's a bit intransparent, but the principle are the same for most of the crypto lending protocols. So here we can see the example. The borrower gonna borrow $100. But he is using BTC as a collateral. He has to use a bit more BTC than he's borrowing money, just because we need, some kind of over authorization here. Why? Just because BTC is volatile assets, and we have to have an ability to liquidate and secure the lender, right? So this is how it works. He is borrowing $100 in the form of Terra, and using BTC as a collateral. So after some time, the money is working, for example, for leverage trading or for whatever type of activity, farming, whatever. The borrower has to send back a bit more amount of Tether, for example, $110 back in the form of Tether, and then he will be able to receive his collateral back. I mean, the BTC. Of course, the price of BTC is changing. Here we showed that the price of BTC remained the same, just to simplify the picture. So yeah, please the next slide. This is CFI or CDFI. the next slide means that in decentralized money making, we have smart contracts, and smart contracts are bringing a lot of new features. For example, as you already mentioned already, immutability, decentralization, permissionless, non-custodians, composability, one of the most important thing and feature in the whole DeFi space, because a lot of applications can reuse each other, and over-collateralization by smart contracts. So next slide, please.
Go on.
In DeFi, it works same way as it works in CeFi or CTFi, but most often there are different currencies. For example, instead of BTC, we are using Ethereum. Instead of Terra, we are using USDC. I have no idea why USDC has much more popularity in DeFi space, because they're basically the same by design, but we have another approach where Ethereum is using as a collateral, and the USDC is actually borrowing by the people to do trades or whatever. So the Ethereum is one of the example of DeFi projects which works like this, as it's shown on the slides. Same as Compound or Aave as well. Please, next slide. Speaking about borrowing and lending, the thing is you can use the same protocol to not only lend and borrow the stablecoin, but actually mint the stablecoin. And one of the first decentralized stablecoin, which is MakerDAO and DAI, its stablecoin, is using this principle. Is using the crypto lending as a principle to mint DAI, and originally started from Ethereum only, so-called single collateral DAI. Right, and right now the MakerDAO DAI is using multi-collateral. For example, USDC can be used as a collateral as well, altogether with the Ethereum. And the thing which is called CDP, collateral debt position, is actually what borrower is taking from the system. So he's sending his collateral, he's opening CDP, and then he can use the stablecoin, which is minted for this purpose. And the last slide in this section, please. By this approach, a lot of different stablecoins are working, and the GCD we mentioned before, the part of our infrastructure, is also using the same approach. Can use GTON or Ethereum as a collateral, and mint the GCD as a stablecoin. So you can see here as the crypto lending works, right? We have classical approach with using collateral, one liquid assets, and getting another liquid asset as a borrowed asset, or we can mint stable coins.
Okay, that's great. Thanks, Alex, for your great explanation. Seraphim, do you have anything to add?
No, not really. You covered it pretty well. So.
Okay. So let's get to the other question. I have a question for both of you. Where do you think the lending market is going? What will be the new money markets and what their features will be? Seraphim, can you go first, please?
Yeah, I think one big problem with lending markets is that they're not very capital efficient. So there has to be a better way to provide decentralized leverage. So I think what's going to happen is people are going to try to experiment more with isolated environments where you have like more leverage, where you have higher collateral and borrow factors. I think that's where we're going probably. Not for just any collateral asset, really. I don't see much use in just taking any old token and using that as collateral, but I think that's more of a thing that is useful when you have interest-bearing assets like stake teeth. Now, stake teeth is a very well-known kind of very liquid asset, but if you wanted to have like something like Squeep as collateral or like Coinbase ETH as collateral, so you need separate environments for that with higher leverage, and I think that's where we're going.
Great, thank you. Alex, go on, please.
Yeah, here's the question. You can open the next slide because we'll see some stats here. Sure. It's not about the presentation. Yeah, the next slide, please. I just want to have a quote around the more margin. Seraphim, I have one question. Is there only one use case for the crypto lending? You mentioned leverage, and I know I think probably only one real use case of the crypto lending, which is basically leverage, long leverage for most of the assets. You know something else?
That's all I can think of as well. To be realistically, everything is done for trading. Well, a bit of margin trading, I guess, but it's not as efficient as perps, right? I guess long-term assets you can use it for like leverage trading. for big assets, I think it's just leverage basis trades, basically.
Yeah, exactly.
Yeah.
So the most of the use case for the lending markets is basically leverage, right? It can be long, as you said, or short term as well. But this is the main idea for that. And here you can see the TVL, not the TVL, but how much funds borrowed. And I have one question here. Why we have this stat? Like, what's the difference between the protocols, like earlier of or compound? Why we have different stat here in terms of borrowed USDC or borrowed ETH? Like, where we can see the difference, where we can see the product market fit or some differentiation between those protocols, how they are living together, etc.
Yeah, I think a lot of, like, in a way, we're all very similar protocols, so it's not very easy to just sort of kind of grow much faster than Aave. But one thing that Euler has done differently, and I think that's going to contribute to more growth, is the fact that we have two-way markets on staked ETH. That's something that Aave and Compound don't have. Like, you can basically short staked ETH during volatile environments, and that's where lenders make additional money. I think historically we've seen that lenders on Euler make additional 2% lending staked ETH without any leverage, like even if they don't put on anything. So that's one thing I think that will kind of change this landscape a bit. Actually, we're integrating Chainlink now, so you can do that with direct staked ETH deposits, because before that was wrapped staked ETH. So I'm thinking that soon that is the ultimate product market fit, two-way markets and staked ETH, and the isolated stuff that we talked about as well. I think it's going to be quite neat because I think Aave trying to experiment with that stuff, and that they're doing a good job with E-mode and everything. But I'm thinking a separate isolated environment is probably a better way to go, because you can do anything there. So,
yeah, as you can see on this on this slide, we can see that in terms of borrowed USDC, you have the third place across all the crypto lending protocols, right? But speaking about borrowing ETH, you're basically actually ahead of Compound, right? So you have some better better positioning for lending ETH, right? Probably it's because
at the moment Compound's frozen, right? So I'm not sure how. Like, because recently there was a bug, right? And the Oracle update basically made ETH deposits.
Yeah.
So maybe that skewed the image a little bit. I'm not sure, but yeah, I'm not sure if it's still. I think it's still frozen. I don't think you can withdraw anything. So. I'm actually surprised people are not borrowing as much ETH on Euler, because I saw the interest rate spiked on Aave because people are preparing for the merge. But on Euler, I mean, you saw a little spike, but not as much. So if someone's out there, like, maybe it's a good trade, like, to borrow some ETH from Euler and just lend it on Aave. Like, could be just blatant arbitrage there, you know. So
it is nice. I have one joke, an interesting joke here. To beat the competitors, you can just exploit them, right? Find the exploit and use it.
Well, it wasn't us. It's exploiting Compound. Yeah. They did it themselves, to be fair. But but it happens to everyone, really. So I'm sympathetic to them. Like, it's like, yeah. I'm trying to be careful, but it happens to everyone, really. So.
We can keep on this slide because I have another question. For example, the use case for the USDC borrowing use case, we already know, right? It's basically long on ETH. Like, you can use ETH as a collateral. You have Ethereum. You can, buy another currencies, and then you have profit. This is why it's working. Why people are actually borrowing ETH, and like, which collateral they're using to borrow ETH mostly?
I think they're using there's two trades. I think you lend staked ETH and you borrow ETH against it, and that way you're trading your basis trading staked ETH yield, basically, with leverage. That's one reason to borrow ETH. Another one is probably to lend USDC and borrow ETH ahead of the merge, where you expect to, because basically after the merge, if there's an ETH proof of work, there's going to be a fork, and you're going to have ETH on both on both networks. And USDC, the Circle guys said that they're going to move to ETH, the proof of stake, and not going to be on ETH proof of work.
Yeah,
so that collateral that you lend, so that collateral that you lend on currently, in USDC is going to be worthless, but you will borrow ETH against it, that which is going to have some value. So effectively, you're having a nice little trade where you risklessly can just get some free ETH proof of work if it has any value, obviously. So I think that's one reason why rates are spiking now. People are just borrowing ETH proof of work, ETH to get ETH proof of work, after the merge.
Interesting. I think we can find something interesting on the next slides.
Cool. Should we go to the next question, guys?
Yeah, you can push the next slide. We'll prepare and you can answer, ask the questions. I think this will...
Okay, I have another question for both of you. Can you please name one key advantage that is a killer feature? I asked that. Okay, now go on. Let's try to envision what new money markets will be and what will be their underlying mechanism. Where's the entire lending market headed? I'd like to hear what you both think. Can you start, Alex?
Yeah, I can. I think there are some topics around under collateralized lending. I'm not sure it is secure or not, because I saw a lot of projects which are trying to do something there, like using using under collateralized positions somehow hedged. But I'm not sure it is stable, especially after the crises of Celsius and another companies and Three Arrow fuck up, and I don't know. I think there will be something, of course, based on reputation, based on another mechanics of redeem collateral. But I don't know. Probably the under collateralized lending can be something big in the future, but probably Seraphim knows more about that. So, and you can add something.
Yeah, I think under collateralized lending has to take off, because that's in TradFi. That's like one of the biggest things that that one of the biggest driver revenues for TradFi, right? It's just there haven't been proper solutions in terms of credit scores yet. I mean, I see some guys like X Margin. They're doing something interesting where there's like an on-chain credit oracle. It's just that for this to take off, why would you do that on-chain if you can do it off-chain, right? So it has to be either higher leverage, or there's some better transparency, or like better transparency as in not like everyone sees your position, but just like the technology is more transparent, or there's not a black box, but it's just very hard for that to happen. I think, you just need more leverage and a much better credit reporting tool than currently, and then it will take off. But to be fair, I think over collateralized lending and under collateralized are really different. Like you could probably combine them in one pool, which would be interesting, like where you have like over collateralized lending, but 20% of excess underutilized capital could be lent out to, let's say, Alameda, for instance. So that would be cool mix, because you basically have what's that?
Or 2 free Arrow capital.
Oh, of course, yeah. Like, I prefer 3AC really, yeah. But, you could potentially do that, and then you limit risks a little bit because only a portion is lent to like under collateralized. So it would be quite cool to see these kind of mixes, I suppose.
Yeah, I have some more to add here. Excuse me, Arya. I have some more to add here. Speaking about what kind of trends can be in the crypto lending, I also noticed that there will be another types of assets used as a collateral, NFTs. And I noticed there are some protocols which are using most liquid NFTs like punks and monkeys as a collateral, because if you have liquidity for any assets, why you do not use it as a collateral, right? But of course, with much bigger over-collateralization ratio, because the volatility there and liquidity is pretty different compared with the liquid assets. And in the same area, we can say that there will be market for so-called RWA, which is like real-world assets. Same. This can be commodities or NFTs, but NFTs for the real stuff in the real world. For example, real estate or cars or whatever. Like whatever you're able to tokenize in different form. We can tokenize thing as a commodity, which is basically the stable coin, right? Pegged to some value. For example, food or oil or gas, whatever, metals. Or there will be some objects. Most probably it can be real estate with the different locations. But here we have a conflict of two sides. We have decentralized rules, and we have custodian stuff and regulation, and this is something which has to be changed in the future. I heard on ECC MakerDAO they have a presentation about how they are going to use different types of collaterals like NFTs and real estates, gold as a collateral for issuing DAI. But yeah, I think this is a question for upcoming years. What do you think about guys? What do you think about real world assets and NFTs as a collateral? Is it working, or we have to do something before it happens?
Yeah, I think NFTs is easier, but the problem is the pricing is just kind of shit. So it's like
Exactly.
the pricing is the biggest issue. Like in TradFi, you have markets on really liquid things, and that's okay. It's just that there's some decent pricing out there. For NFTs, it doesn't seem as reliable, but I have to have a look again. I think that's the biggest issue because you can easily manipulate like the pricing and just borrow whatever you want against it. That's like the biggest challenge. So for real world assets, I haven't given it too much thought, but I feel like it would probably be more about automating the current the current like banking institutions, just automating things using smart contracts rather than bringing things completely to DeFi. Like I just like when it comes to cars and like houses, I just struggle to see how you can do it without some form of like real life stuff like IP rights or legal recourse. It's just like no one can liquidate your house on chain. They have to go and sell it, right?
If it's NFT and we have a pool like liquidity pool or enough demand for that or enough hype, I think it's not a problem. But yeah, you're right.
Like if an NFT represents a legal claim, that makes sense because it basically just automates whatever happens now and just gets rid of all these back office jobs and just does it on chain. So that could work. It would be more like an automation thing rather than a DeFi thing,
From one perspective, I agree. From another perspective, Tether has no legal, enforcements to redeem the USDT to dollar, right? It's basically based on trust.
Fair, but I think it's over collateralized, isn't it? So it's like you can, the reserves. I mean, I guess if you're using it, you can redeem that stuff. So they do have a legal entity, I think, right?
They have, but if you read the terms, there is no guarantee. They basically say that if we have no possibility to that, we will not do that. So it's
fair. I think it's more like you usually can do it. Maybe there'll be times when you can't, but if you have a house and there's an NFT that represents it, there has to be some sort of legal recourse because if I'm a bank, I'll not take your NFT which represents your house unless it's a real house. I'm just not going to take it. And with Terra, it's like they have some reserves, so it usually works because I know people that move insane size every single day in Terra, so that's happening. If they said that's not happening, no one would use it, right? So.
Exactly. Yeah. So
okay, guys, let's go to the next question. It's one of the most important things in DeFi in these days, and that's about the regulators. I have a question for both of you. What do you think about the latest precedents with authorities imposing a ban on the biggest protocols, including lending? Don't you feel that it undermines one of the biggest things in decentralized money markets, basic principles of it? And decentralized protocols used to be censorship resistant, have a censorship resistant structure at the beginning, but I think that now they're losing this. What do you think about it? What's the problem and what's the solution?
Difficult question. I have no idea how to answer, especially after recent Tornado Cash drama. So Serafim, I don't know what do you have in mind around that?
Yeah, I mean it's sad because if you look at Chainalysis and I think we use Chainalysis to you see it on Uniswap too, like tiny part of the transactions are linked to dodgy addresses really. So it's like it's like with cash, United States cash, like dollars themselves, a lot of them there's a decent proportion used for money laundering, but we shouldn't ban US dollars, right?
Yeah, it's strange.
This is the same thing. Like most of DeFi, 99% is used for legit trades and innovation. So that doesn't mean we should. Terrorists also breathe air. What we're gonna start handing it out to like by subscription. You know, it's just a bit weird. So that's my opinion on it.
Okay, cool. Thank you, guys. Let's get to the next one. How can we address the prevalence of a handful of major assets in the crypto markets? What do you think about projects creating new lending markets for low cap tokens, like one of our partners, Range Finance? How can we make the markets more diverse overall? Can you explain, Alex, please?
I know we have a slides here with the assets, the most popular assets for earlier. Probably it is 2 slides more because this will be interesting for context. Yeah, this exactly this. And so as you can see here, most of the trades are happening on the most liquid assets like Ethereum, USDC, DAI, BTC, etc. Right? And if you look at the rest, even on the earlier, which is mostly using the liquid assets, if you look at their TVL or at their usage, we'll see the long tail and thin tail actually. So the question here is why the DeFi system is so centralized in terms of assets, like why everyone is trying to use liquid assets. And it's actually bring even more liquidity, but the long tail assets, they have no utility, they have no liquidity, and we have chicken egg. How it works, how to build something which is which is over it, which is solving the issue for the long tail assets.
Yeah, I feel like it's just the nature of liquidity. Like if you have good liquidity, you can offload. If you do have a liquidation, you have a liquid asset, you can offload it easier. There's a lower chance of bad debt. It's probably a bit less volatile. So it's one of these things that's scalable. The more liquidity, the more you want to use it. I also don't see more, like mostly if you look at any sort of flows on centralized exchanges as well, most of the trading is, again, ETH USDC, it's Bitcoin perps. On Uniswap, the biggest trade is always ETH USDC as well. It's like the 1/3 of their volumes as well. So I don't think that's going to change, to be fair. Like people like to trade small assets, but it's very skewed in terms of assets under management of big funds, right? There's a couple of guys trading insane size and they just can't trade GRT or like tiny tokens, right? So it's one of these things that's very scalable. Sorry, like not scalable to trade small assets. That's what I mean.
Okay, cool.
It's not answered actually, because the question is here, how to avoid this chicken egg? Because illiquid assets cannot be liquid because there is no lending for that, there is no liquidity for that, and it's basically within its own bubble. And this is why we have like concentration liquidity on the already liquid assets, but long tail assets, they are like they're almost dead comparing.
Well, I think it's the underlying project has to do well and be used, and then this will naturally happen. I think if you're a project that suddenly becomes extremely used, that people want to use that token as collateral or whatnot, and liquidity will improve. So I don't think it comes from the market; it comes from the underlying asset itself, or the project itself.
Arya, you have something to add here?
Okay, yeah. I just wanted to get to the next question. If you guys are okay with this. I think
we'll just keep it as unsolved, or somehow the responsibility of the projects to push the assets to the new league, right? Because I don't know, it's difficult. It's basically based on utility, right? The more utility you have, the more demand you have, liquidity will follow it. So probably this answer.
Yeah, I think so. I think the same way. Yeah.
Great, thank you. I think it's the right time to talk about the product side of things. User experience is a buzzword in DeFi, as you know. If we take lending and borrowing, what does the reference user experience in DeFi look like? What do you think? What will this be? Go on, please, Alex.
I think it's simple, right? First of all, you have to explain why users have to do that. Because if you explain that for traders, it's better to say, okay, you don't have to sell your BTC or Ethereum. You can just use it as a collateral, get some stablecoin, do trades, and then you can have it back. Of course, you pay something, And for traders, I think it's easier to understand just as a leverage. You know, it's basically leverage trading. If you try to explain the crypto lending for people who are not in the trading industry, or you know, have no experience with trading, you will see some you know, question like why why should I do that? Like can it, like I noticed one interesting joke in Twitter. The guy asked like, can I borrow some money from Ava to buy the car? And it was, the answer was no. So the guy said why I need it, you know, like why I need this crypto lending for. It is exactly about that, because if people don't understand why they're using lending protocols, mostly crypto lending, they will not use it, and this is most important thing here. So I don't know, Seraphim, you have something to add here?
No, I agree, and I also think what people should understand in retail is that lending protocols are made to transform your idle assets into working assets. They're supposed to find you yield, and it just gives you that opportunity. Like if you have USDC, you can maybe put it into Euler or Aave and use it to earn yield on staked ETH, you know. But it's basically, lending protocols are enabling you to earn additional yield if you do it well. That's really it. It's not like to borrow a car or a house. It's more like, how do you make more money using your capital? That's really it. So maybe what has to happen for retail, we're trying to work on this as well, is to create a simplified UI where we have vaults, where you literally just put in your USDC or ETH underneath. It's open source, but it's something like GTON basically, where it just accumulates more yield where you put it at work. So I think that's the best thing for retail, is just to put it there and not think about it too much.
Yeah, interesting approach. Interesting.
Great, thank you guys. And what do you think that this bear market brings crypto industry? Will it affect the market? I think it already has affected the market, and it has changed the crypto industry. What do you think? Will it change the crypto industry, and how it will be?
You can open the slide with the TVL, so we'll see the, you know, how the how the bear cycle is actually influencing the metrics. Most of them are basically vanity metrics. In my perspective, I don't know, probably somebody is not agree, but yeah, if you look at this, you'll find that during the crash of the markets, all the metrics are basically dying, right? We still have two main use cases, which is basically DEXs and lending, including CDP. But this market following the trends as well, because if you have, if everything is growing, people are you know, they are using more collateralization, more leverage to get extra profit, right? If everything is going down, shorts are a little difficult to use in DeFi. There are not so many short opportunities for assets, so this is why it's basically you know, dying for some time. I don't know. Nothing to add here, actually.
Yeah, I think what bear market did was first of all, retail involvement kind of collapsed. So we integrated with Instadap 2 days ago, but we haven't seen yet any much inflows, you know, because retail is pretty much dead. So that's one thing. So far, DeFi seems like just a bunch of big guys moving size around, trading stuff. You know?
Yeah, exactly.
There's not much. Yeah, there's not too much trading from anyone else. But in terms of raising capital, I think good projects still raise capital. I still see decent valuations. You know, if it's a good capital, it's just if it's a decent project. It's just that maybe a few months ago, if you were any project, you could raise a lot of money, and now it's just very few. But valuations are still decent. So yeah, generally just growth has slowed down a lot. So it's not, if you haven't raised enough money now as a project, if you don't have enough runway for a few years, it might be a bit scary. So
yeah,
a lot of projects are actually running like they don't have enough cash in their coffers as well, you know, which is quite alarming. So yeah.
Cool, thank you. And the last question, why only Ethereum? Most of the DeFi transactions are done on Ethereum network, you know, and why are people only using Ethereum? What do you expect from the merge, and do you think this will affect the project in any way? Alex, please.
I prefer Seraphim to answer because they are only on Ethereum, so I have a bit more questions. Yeah, can I pass it to Seraphim?
Yeah, go on, Seraphim, please.
Yeah, I think it's just economies of scale. It's like most of liquidity and activity happens on Ethereum, and very often activity that seems to happen on other chains is just fake. Like we've seen recently, like there were certain headlines that a lot of activity which is absolutely concocted, basically. So Ethereum is like one of these places where it works, it doesn't shut down. A lot of people are comfortable with it. There's lots of capital in it, so like it just makes sense to grow there. But I do think rollups are pretty cool, and Polygon and a bunch of other chains, you know, will be pretty useful for things that are more, well, where you have to trade more often. Like if I created some effects pair, if I traded that on Ethereum, that would be extremely expensive to trade all the time. You know, so the higher the leverage, the more probably the cheaper the fees have to be. So I like rollups from that perspective. In terms of the merge, yeah, I think there's two risks. So the risks of high utilization, that people just borrow ETH for that trade we mentioned, where they just want to get free Ethereum proof of work. And the second one is after the merge, there's a possibility that the TWAPs, like Uniswap TWAPs, for instance, are going to be a lot more kind of prone to attacks, because basically now it's quite expensive to manipulate the TWAP because of the way things work. But the moment there's once the merge comes in, a validator will know in advance basically which block they'll get, and that's where multi-block attacks become a lot cheaper, it seems. And also there was a paper recently where somebody just someone posted a few weeks ago where the possibility of, like, if someone owns like 20-30% of the network, there's like a 90% chance they can like ram in 2 blocks at the same time. So I have to check how that compares to proof of work, but it seems like it's more aggressive than proof of stake. So that makes TWAPs a bit more risky, which is why we're integrating with Chainlink as well, actually. So that's happening now.
Yeah, the TWAPs, they have an issue with the on-chain manipulation. It's true. Speaking about that, the Ethereum, I think it is already known that if you are in Ethereum, you are in the global environment, right? There are a lot of layer 2s started, etc. Of course, the main chain is quite expensive, so probably it's okay for the bigger capital to be managed, right? But speaking about retail, they need low transaction. They need low transaction fees. They need higher speed, and there are good solutions for that, which are rollups. Started from optimistic rollups, and then in a few years we will have perfectly working versions of ZK rollups. I'm pretty sure they will be the case, because right now we have dominance of optimistic rollups. Speaking about Polygon has its niche, which is mostly about the GameFi, the social fi projects, NFTs, etc. So it is perfect application for that. Probably in Polygon we will see something like merging of DeFi and NFT sector, because they have both some certain developed. Speaking about merge, actually it seems like no one knows what will happen. Actually, it seems like we are doing something. We already have a confirmation from the centralized stablecoin issuers that they will prefer the proof of stake version, so there will be no forking of stables. They will be basically worthless. But this is actually bringing another thing. There will be something like huge fluctuation in the Ethereum POF, and also opportunities to get profit from that, because not all token issuers are able to choose the network. Probably some of them will speculate on do both. And this is have its pros and cons, and the cons is that there will be huge volatility. No one knows where, up, down. There will be just something. And of course, oracles here is an important question, and I think this is what I promised to ask you. Why you, as a project, going to develop your own oracle infrastructure? What's the reason for that?
Yeah, it's just because, again, as Uniswap TWAPs will not be as secure, it seems. I don't know if they're going to implement another TWAP anytime soon. And Chainlink, it just seems very concentrated risk for the whole DeFi to just use Chainlink, to be honest. And any other Oracle solution seems to be extremely centralized. So I think it would be just good for the ecosystem to have a more decentralized Oracle solution that has good TWAPs on it. It's kind of a matter of necessity, really, rather than like just hedging the extreme tail risk of something going completely wrong, you know, rather than, I mean, maybe it's a commercial opportunity, which is big, but I think from it more of a hedging tail risk kind of thing, you know.
So there are one project which is really big, the MakerDAO. They are not using Chainlink, right? They are, you know, relying on their own oracles. Why they are not scaling that further for more products, more dApps? What do you think?
I know there's like lots of conspiracy theories that get around it, but I don't want to talk about them today.
Okay.
It's convenient to have your own oracle, obviously, for many reasons, but like I think it's a matter of being as decentralized as you can, which we think it's important. So we try to decentralize every aspect, liquidations, oracles, kind of everything, right? Because it's like, is it really DeFi if the price feed is like decided by the core team?
Yeah. Basically, the most of the markets in DeFi works like that. Arvia, you have something to add here?
Yeah. I wanted to just go to the community questions, Alex. If you guys don't have anything else to add, we can answer some of our viewers' questions.
Oh, let's go.
Okay, why is AAV launching their own stablecoin? What do you think, Seraphim?
Who's launching? Sorry,
AAV. Yeah.
Oh, right. I haven't made up my mind yet. Actually, I might meet some people who work on it just to understand what they're trying to do. But it obviously if you can create liquidity, on-chain liquidity for it, it's definitely a good idea. It's just a question: can you do it? Because there's a lot of really nice stablecoin projects, but they never really took off because we haven't been able to build that liquidity. So, like if we wanted to do it, we only do it if we felt like we can quickly build that liquidity. Otherwise, it's not very useful. So we'll see. Like it all depends on that, I think. So
you have no plans to launch the stablecoin earlier?
Not at the moment, no. I don't think we do.
Okay.
We eventually might do it. It's just we have to be certain that we can build that on-chain liquidity extremely quickly. Like even guys like Eurocoin from Circle, they had a very tough time building on-chain liquidity so far, I've seen, right? And they're a huge company, so it's not exactly easy. And if you have a stable coin that is very good and nice but has no liquidity, I mean, can you integrate that as collateral? No. Do you actually use it for things? Not really. So that's
it's a main question for stablecoins, like the use case. Yeah. Interesting. So you prefer more to go to the Oracle side, right? And infrastructure and other opportunities to scale the area.
Yeah, it's something we know, and that we don't think we have to bootstrap it with a lot of rewards and stuff like that. So I feel like Aave will have to really bootstrap this with lots of Aave tokens.
Yeah,
unless the infrastructure they came up with is so like a 0-to-1 move, which I don't know what it could be in stablecoins, but maybe it is. So like I'll be interested to see. It's just it's hard to know. Can they really be a lot better than DAI? That's like the question, you know.
I think everything which is not using 70% centralized stablecoin as a collateral can be better than DAI, but let's see.
Also, but in terms of like, growth, I mean, like LUSD is brilliant and I love it very much, but I don't think they've built lots of enough liquidity, more or less, right?
Yeah, that's true.
Let me just see how much they got on Curve.
Cool.
I obviously
Alex,
love the project.
What?
Okay,
yeah, let's do the next question from the community.
Okay, the next question, I think we have mentioned it already. What must be done to attract more liquidity for the low cap tokens on the current money markets? And does the market need it whatsoever?
We already answered somehow, but I don't know.
Yeah, I think we mentioned this already. Let's move to another one. How can the money markets be protected from the liquidity draining from the pools? What attack vectors on the lending protocols do you find most possible and risky, and how do such platforms have to change to avoid them?
Oh, interesting question.
Yeah,
Seraphim, I have no answer for that except of proper risk management framework and collateralized ratio management. But if you have something to add, please say something.
yeah, I think collateral ratios for sure, but also just generally good pricing. So if the pricing is bad, you can inflate the value of the collateral, and then you just borrow anything you want against it, for instance, right? That's one thing. Second thing is actually, let me turn off my AirPods are dying. So
there you go. You can hear me, right?
Yeah, a little different. More buses.
I hope it's fine. Yeah. You can, if you manipulate the pricing, you can pump the collateral value, borrow a lot of it against it. The second one is you could like collapse the value of the thing you're borrowing and lend a little bit of collateral and steal the whole thing. That's what often happens too. The pricing is pretty much the biggest thing. Second is bad debt, like just on-chain liquidity for liquidators. You can't sell the collateral asset, you're not going to liquidate. So basically, like the lender of the asset that you borrowed is left without it, while the collateral value has gone down. So that's not as prevalent because unless you use something really dodgy as collateral. But yeah, these are the three vectors I can think of that are quite prominent.
How it's managing on earlier side? Is it like DAO proposals for any parameters like on app, or you have different approach?
It's the same. It's like forum and people propose factors pretty much. Yeah.
Interesting.
Okay, cool, guys. Let's get to the last question of our community, and then we can end the discussion. What do you think about Alameda and FTX bailing out many protocols that suffers from recent attacks? Don't you think that in this way they are making the market dependent on them and therefore more centralized? Won't it be better to let protocols fail rather than become dependent on one deep pocket entity? Interesting question.
They actually, like, for 3 years I following them, they became some kind of evil for DeFi and CeFi, and everyone is speaking about Alameda is kind of like, you know, hustlers who is making money brutally reading the protocols and tokenomic designs, and I don't know what to add here.
I mean, the answer's in the question a bit. Like, yeah, it's not great when one. It's not great when one. So it depends, right? If you talk about centralized providers that they're buying up, I'm not sure if anything actually went through. Like, I think they tried to buy BlockFi, I think, right? So I'm not sure if that's happening anyway. But assuming what have they actually managed to buy? Do you guys remember? Like,
No. I don't remember. I remember Terra Luna, but it's more gossip than the.
Because I remember there were lots of talks, but I don't know if anything actually came through it. But the point is, like, if you buy a lot of centralized providers, I actually don't care as much unless they start lobbying that everything has to go through CeFi first before so retail cannot never access DeFi directly. That would be alarming. But when it comes to DeFi, it's not like you can buy. I don't think they're buying like stakes and protocols en masse and enforcing their opinion there, because that just looks like that's very public. That's one of these things that's extremely public and they're not doing. Obviously, Alameda's money is everywhere in every protocol, right? And that creates a certain amount of risk, but I don't think it's that bad because supposedly DeFi can survive even if a lot of people pull out, right? So I think the biggest risk Alameda pose might potentially is that they capture the entire CeFi and then lobby governments to like make sure that everything has to go through CeFi to get. So to get to DeFi, you have to use their CeFi. So that's like. But I don't see much risk of their money sloshing around DeFi so much, to be fair. I actually think it's quite helpful because like over the years, they've been doing things that made protocols stronger, you know. They've been seeding lots of projects and raising money. So yeah, my concern is more CeFi and legal. They're trying to take.
Yeah, interesting. But not about their way to actually broke the protocols, right? To get extra money.
Yeah, I think they grew so big. I don't think they care anymore about like they're not North Korean hackers, you know. They realize they do it, they'll find them and someone's gonna fucking imprison them, right? So they're not idiots. I don't think they're doing I don't know what they've been doing before. Like, to be frank, like I don't know exactly. I mean, I've seen some of the things they did with like Venus and stuff, but these are like obvious mistakes that the protocols have made to list certain liquid assets as collateral, right?
Yeah, exactly.
That makes a lot of sense, but I don't think that I don't think this is as aggressive as some people think. You know, it's actually like a bad protocol choice to list something really liquid as collateral, for instance, right? It's not Alameda's fault, is it?
Nice answer.
Yeah.
We have an interesting thing on the slides. Arya, I will ask you to find the slides with the TVL of earlier finance, and this slide, and we have really suspicious spike here in June. The DeFi Llama showing this as whale deposit, but speaking about Alameda, right? You know what happened here? Because it's basically one transaction or something like that.
Yeah, what happens often is everybody tells me, like even guys from Notion have said, one day they're sitting and somebody just dropped a fuck ton of size. And I think that was after we announced I think we announced like the rewards or like the gauge system. So for Euler distribution. And I think somebody just came in and fucking dropped a lot of size basically. I mean, I think it's spread out across wallets. It's probably the same person. So whoever it is, I don't know, Alameda or Justin Sun, or who put their money in, I don't know. But it does show that in DeFi, a lot of things are much more concentrated than people think. Like if you look at distribution of like, actually these guys have built a really cool dashboard for Euler recently. I'm going to announce it soon, where you can kind of see like distribution. If you check the graph, you can kind of see distribution of accounts and health factors. And it's on every protocol, if you look at RV2, it's extremely skewed. Like very few guys drive most of the volumes. And it's like, it's just the reality of DeFi, really. Yeah, actually, if you can see yeah.
And the DeFi projects, they have like a few hundreds of real users.
Yeah, if you look at RV and Euler, both of us, like if you look at the sizes involved, I think distribution on RV is a bit better, but overall, like top 100 accounts on RV drive probably like 90%, and Euler, because we have fewer accounts, probably top 20 drive most of the volumes. And same when people deposit capital into Euler, one or two guys drive a lot of the TVL. It's just one. So until the bull market returns and retail start trading, I don't think that's going to change pretty much. It's going to be like one or few guys driving the whole thing. So
the Satoshi of the DeFi, right?
Yeah. Yeah, it's just the reality. I don't like saying that there's just one guy drove all this TVL, but it's just the reality.
But this is kind of true. What you can do, you're building protocol, right? You cannot control who is, you cannot control diversity. It is another story.
Yeah. It's like we just have to build good products, hopefully integrate. I mean, we integrated with Instadap a few days ago, which is quite neat. It's just that, again, there's not so much retail money sloshing around, but once it returns, we want to make sure it's more diversified and not like two whales, like providing.
This situation has its dark side, and the dark side means that if you have something like incentivization of liquidity provision or something like that, your imbalance in terms of deposits funds became the imbalance of the governance token holding, right? So it's basically turning that into the centralization issue, like how protocol is managed, and there is not so much, not so much different from the CeFi, because if you have like two or three, persons or whales or whatever organization who basically can dictate everything with the protocol, like different collaterals, IPOs, whatever. This is a risk, and this is why I think Vitalik personally care a lot about different frameworks around governance, because if you have something like quadratic voting, you basically somehow is able to solve this issue, right? You have more democracy in the protocol. But yeah, speaking about deposits, this is one thing, because no one actually care how much I deposited in another person if it's not influencing directly my funds, my ratios, and
I think as a project you could either do something innovative like this, quadratic voting, or when you like raise capital, or you have like a treasury diversification event, like we had with Horn Ventures and a bunch of other guys, to make sure that it's a diversified base of firms that you sell these, that the DAO sells the tokens to, because that way, you know, like, or Jump might like Terra Luna, but Horn Ventures like don't maybe necessarily agree with that. So you know that at the end of the day, there'll be some discussion and debate rather than them just colluding and doing something, right? So that's like, it's a very raw strategy, but it makes sense if you're raising funds, or as a DAO, you're selling tokens. Unfortunately, it seems like in the world, very few things are, most things are skewed by a small number of entities. It's just the Pareto principle. So maybe quadratic voting can solve that in some way or mitigate. I would hope so. But reality is, it's just a few people deciding most things, and you just make sure that they have slightly differing views, and that they compete. You know, it's like you have a couple of intelligence agencies, so they compete against each other, right? You know, there's this dynamic. There's a reason why, I think I read about this, that maybe it's crazy comparison, but Stalin, he created 2 agencies per, I think he split every agency into 2, so they would compete basically, so they wouldn't get rid of him. But that's the same.
It is bad case, because they're basically killing each other as a repression, right? So
Oh, yeah, but I mean, you see what I mean, right? It's just, it's important people compete. Even the whales, you know. So
yeah, we have to have forces and anti-forces. It is true. You know, the US politics works. They have 3 branches of power, right? They have, and they are competing with each other. Because like judge, they are not forcing forces, they are not making laws, they are not forces and not judges, and somehow they are balancing each other. And and another story is, sometimes it's called oligarchy, right? If you have a few members who basically making decisions, you have oligarchs within the protocol.
Yeah, it's true. The question is, do they collude or not as well? Because sometimes you just can't avoid having a few oligarchs, but the question is, are they all under one guy who just tells them what to do, like in certain countries, right? Or you have like a more diversified kind of oligarchy.
Diversified oligarchy. I like the term.
Well, that's what DeFi at the moment. That's what DeFi is a little bit. It's like a kind of a. I think it's not like a bad case. It's like a diversified oligarchy where a few guys driving it, but they don't have the same views. So that's at least better than what could have been, right?
Yeah. And you have an opportunity to run your own protocol if you have something to offer for the market, and you know, you can basically be one of them in the short time, like a few years. And we saw it with the projects like Polygon, for example. They started from like almost nothing, and right now they kind of one of the big protocol. For example, they have a lot of TVL, but it is an opportunity. This is why I like Web3 and DeFi as well.
Yeah, it's good old school capitalism, I think. It's just Wild West, and it's cool, and people can rise very quickly if they have something to offer. So yeah.
Okay, guys, thank you. I think that we have come to an end. But before that, if you want to come with some conclusion, I will be more than happy. We will be more than happy to hear that. Anything?
I can say a few words here. We have this GTON Academy live streams to first of all to educate the people who is probably new in that particular sectors, for example, crypto lending or DEXs or whatever, because you know the funnel works like the retail people, they know about mostly meme coins, etc. And then they start working with that. They have more and more experience, and the streams like that is a good opportunity for them to actually go deeper into that. And it is amazing to have the guests from the top from leading protocols, because we have like direct information and direct views and direct opportunity to ask the questions directly. So the conclusion is pretty simple. Look at this. Try to educate yourself about protocols and ask more questions. We'll try to find more guests and more interesting topics around the protocols. And the education is a key feature for crypto adoption, because this is only way how we can basically increase the the audience of Web3 users, DeFi users, and crypto users in general. So yeah, I think it's all from my side.
Thank you, Alex. And Seraphim, what about you?
Yeah, from my side, just yeah, if you're interested in Euler, let me know. Just you can ping me on Twitter. The next big development is that we're integrating Chainlink. Actually, that's already done, and listing stake TP as collateral. So we have two-way trading, which means you can lend more. You can make more money lending probably than Aave, which doesn't have any borrowing. So it's going to be a big development. And yeah, let me know if you have any questions or about what we're going to do, how to use the protocol. Just ping me on Twitter.
Really interesting to see your approach to the oracles, because to app Chainlink, only two alternatives. If you'll suggest something interesting here for DeFi projects, really interesting to see. And probably on the next stream, if you have something to show, we'll definitely explain the different aspects around that.
Yeah, definitely. Once that's live, you'll know. So be happy to come over.
Okay, guys. So let's wrap up. Thank you both of you for your time and for your great explanation. We use it, and I think we have learned a lot. Thank you, and have a good day.
Thank you. Have a nice day.
Cheers.
Olga, you are here?